Welcome to Informed Investor. It's that time of the year, budget season in India. Finance Minister dropped a 1 lakh crore tax bomb. Surprisingly, this wasn't on you but for you. Will it work or is it just a gamble? So today we'll discuss the recently announced Union Budget of 2025, focusing on just the major changes and announcements. We will break down the expenditure and receipts and examine the crucial aspect of the glide path to fiscal deficit. Finally, we will explore the sectors that will be impacted by the budget and highlight the significant takeaways. Let the budget games begin. You're watching Informed Investor, an initiative of Equentis. The Finance Minister Srimati Nirmala Sitharaman presented her 8th budget on February 1st, which lasted 1 hour, 14 minutes, or rather 74 minutes. In context, the longest ever speech was delivered by her, lasting for 162 minutes, approximately 2 hours, 40 minutes, back in 2020. This puts her in status in line of holding the record of presenting the most budgets on the trot. 8 consecutive budgets under Prime Minister Narendra Modi. Former finance ministers Morarji Desai, P. Chidambaram, and Pranab Mukherjee have presented more budgets but under different prime ministers. So, anyway, this year's budget had witnessed a shift of focus from heavy capital spending to boosting economic growth through higher consumption via reduced taxes and job creation. And building on the lines of Viksit Bharat, the vision to make India a developed nation by 2047, the government has mentioned 4 powerful engines for this journey of development. Firstly, focus on agriculture, focus on MSMEs, focus on investments, and lastly, exports. Okay, now, without any further ado, let's look at some key announcements made during the budget. First things first, let's talk on the hottest subject, which was Part B of the budget, tax, tax, and tax. But before that, let me just put some facts ahead of you. Over the years, India has witnessed an increase in direct taxes. But the point to highlight here is that personal income tax has surpassed corporate tax in recent years. This basically means that individuals are bearing the brunt and burden of high taxation. And just to put things into perspective, there were about 8.09 crore individuals who filed the returns in fiscal year 24. With the current population of 142.86 crores, this means only 5.6% of them actually pay income tax. Even if we consider just the 96.88 crore eligible voters, the number barely rises to 8.3. So while the entire nation watches the budget 2025, it's only a tiny fraction that's actually funding it. Let that sink in. So anyway, back in 2020, the government had introduced a new tax regime with the intention of simplifying the tax system for taxpayers. Since its introduction, the government has made continuous efforts to make the new tax regime more attractive.
No income tax payable up to income of 12 lakh rupees.
Additionally, the finance minister announced the following slabs. 0 to 4 lakhs will be nil tax. 4 to 8 lakhs will be taxed at 5%, 8 to 12 lakhs at 10%, 12 to 16 lakhs at 15%, and so on and so forth, as you can see. This new structure is designed to benefit a large section of the population, especially salaried individuals, by reducing their overall tax liabilities. But the biggest debate is whether the middle class is going to benefit from this or not. So let's take an example and understand this better. Let's suppose an individual is earning 12.75 lakh per annum. Let's compare it with the previous new regime and the latest new regime. The government last time had increased the standard deduction to 75,000 and it has kept it intact. And well, this is the only deduction allowed under the new regime. Based on the income tax slabs with respect to the tax liability under the previous new regime comes at 80,000 rupees. And let's not forget 4% cess, which is a tax on the tax. Hence, the total tax liability comes to 83,200 rupees. If compared with the latest changes, individuals earning up to 12.75 lakh rupees do not have to pay any taxes. This does not mean there is no tax rate for this slab. Instead, it implies that through rebates, the effective tax liability becomes zero. Hence, thereby shifting to the new regime, you end up saving a massive 83,200 rupees. But what if your taxable income is just 10,000 more than the limit? For example, if your taxable income is 12,10,000, does that mean you suddenly have to pay 61,500 in tax as per the calculations of the tax slabs? Seems unfair, right? After all the confusion surrounding this, the finance ministry clarified the issue. So basically, there is a concept of marginal relief. Marginal relief ensures that taxpayers earning just about 12 lakhs don't have to face an excessive tax burden. So if your income is 12 lakh 10,000, the tax actually payable would be equal to the amount of income above 12 lakh rupees. So 12 lakh 10,000, the tax payable would be 10,000. For 12 lakh 50,000, the tax payable would be 50,000. This would go on until 12 lakh 70,000. And beyond 12 lakh 75,000, there will be no marginal relief and you will have to pay tax as per the slabs. Let's take another example. What if your total income is 20 lakhs? Let's understand. Considering the standard deduction, your taxable income is 19.25 lakhs. Now, under the previous new regime, based on the tax slabs and cess, your total tax liability ends up at 2,78,200. On the other hand, with the latest new regime and the revised tax slabs, your total tax liability ends up at 1,92,400. A direct tax saving of 85,800 under the new regime was announced. And as mentioned earlier, marginal relief will not be applicable for taxable incomes beyond 12.75 lakh. It is important to note that income types such as capital gains are excluded from this tax relief and will be taxed at separate short-term capital gains and long-term capital gains at 20% and 12.5% respectively based on the holding period. Now, all in all, you have seen how there is a massive reduction in the tax outgo. Essentially, if you earn up to 12.75 lakhs a year, you won't have to pay income tax under the new regime. As a result of these proposals, the government would be foregoing rupees 1 lakh crore in direct tax revenue. This thereby puts 1 lakh crore more money in the hands of people, boosting spending, saving, and investing, which are key drivers of economic growth. By easing the tax burden, the government is strengthening India's consumer-driven economy while simplifying the system and building confidence. But wait, why is this so significant? Let me explain. The biggest issue we're dealing with is slowing economic growth. India's GDP growth rate dropped to 5.4% in the July to September quarter, the lowest in almost 2 years. Some experts say this might be as low as we go, but there's still a concern that the slowdown could drag on longer than we'd like. Now, to make sense of this, let's break down what drives our GDP, or in simpler terms, the economy's growth. Think of GDP as a combination of 4 engines. Private consumption is the money we spend on daily life, eating out, buying goods and services, spending on healthcare, etc. Basically, consumption by us. It's the biggest piece of the pie, making up about 62% of our GDP. Then comes investments, is what businesses and the government invest in, like building factories, buying equipment or infrastructure projects which add value to the economy. Investments account for 31% of GDP. Then there is government spending, which is what the government spends on things like roads, schools, and hospitals. Net exports is the difference between what we export and what we import. India imports more than it exports, so this part of the GDP often has a negative impact. Now, here is the problem. 3 out of the 4 engines are slowing down, but it's mainly the private consumption. People are spending less, which is hurting private consumption, as you can see on the chart. Private consumption grew 6% slower than 7.4% in the first quarter. And remember, this makes up 62% of the GDP contribution. When we spend, businesses thrive, jobs are created, and the economy grows. And in the previous budgets, the government focused heavily on capital expenditure, or capex, as a means to drive growth. The strategy aimed at building infrastructure and long-term assets, roads, bridges, and public facilities did not yield the expected results. Even private companies were not investing as such. This realization has led to a strategic pivot towards stimulating private consumption instead. By foregoing 1 lakh crore in potential tax revenue through reduced personal income tax rates, the government hopes to ignite consumer spending and spur economic activity. Now, coming back, as I mentioned earlier, the government is making the new tax regime more lucrative so that everyone opts to the new regime. It has been trying to push individual taxpayers to the new income tax regime for 5 years now, but this might be the biggest and the most decisive push to get people out of the old regime towards the new regime. The revised tax slabs make the system fairer and more progressive, benefiting a wide range of middle-class earners. For those of you who still prefer the old tax regime, which includes several deductions like the ATC, ELSS, HRA, interest home loan, premiums paid, and many more, we got nothing. The budget 2025 has not made any changes to the old tax system. If you want us to cover which tax regime is best for you, the old tax regime or the new tax regime, let us know in the comments. Other than the income tax cut, the government has preferred continuity when it comes to its economic policy. It has retained its focus on capital expenditure led growth. If you see, capital expenditure for budget 2024 was revised to rupees 10.18 lakh crore from the earlier allocated 11.11 lakh crore, while the estimated allocation for 25-26 stands at rupees 11.21 lakh crore, or 10% increase. In terms of GDP, this stands at 3.1% of GDP. The government has restricted growth in public spending to stick to fiscal consolidation. Interestingly, despite the center pushing capex up sharply in the past few years in a bid to revive the economy, the growth started slowing down as 5 years of high inflation and low wage growth eroded people's purchasing power, resulting in a consumption slowdown. Now, sustained growth in consumption will not be possible unless more jobs are created. And hence, to further incentivize spending and stimulate demand, the government has proposed several measures aimed at employment generation, particularly in labor intensive sectors. Considering the demographic dividend that India enjoys, the government focused on supporting startups, micro, small, and medium enterprises, and specific industries while also addressing the needs of gig workers. For MSMEs, the government enhanced the credit guarantee cover for MSMEs significantly from 5 crore to 10 crore. This will offer them additional credit to the tune of 1.5 trillion over the next 5 years. Additionally, 10,000 crore fund of funds and focus on deep tech funding are expected to give early stage ventures access to much needed capital and boost hopes for the next wave of innovation in key sectors including electronics and EV battery tech. The government expects this to benefit an impressive 161,225 startups recognized by the DBIIT. And apart from this, the government has announced a slew of measures for the footwear, leather, and toy sector. Lastly, the government also announced social security measures for gig workers, providing them healthcare under the PM Jan Arogya Yojana. This is expected to benefit close to 1 crore gig workers. Through these initiatives, the government seeks to create a multiplier effect, enhancing employment opportunities, boosting consumer spending, and ultimately driving economic growth. Now, moving on to our next segment, which is looking at the receipts and expenditure for the current year and the next fiscal year. If you look at the table on your screen, in the breakup of receipts or income, net tax revenue, which includes several taxes like income tax, corporation tax, GST, customs, excise duty, is estimated to record at 25.5 lakh crore, slightly lesser than what was budgeted last year. For the coming year, it is estimated to be 28.3 lakh, an increase of 11%. Non-tax revenue, which consists of items such as interest receipts, dividends and profits from RBI and several public sector companies, is expected to grow at 9.8% for fiscal year 26 to 5.8 lakhs. Disinvestments, which is a process of selling or liquidating assets or subsidiaries owned by the government, is expected to be 47,000 crore for fiscal year 26. While the government had ambitious plans of 50,000 worth of disinvestment, it has revised it to 33,000. Now, when we look at the expenditures, revenue expenditures, which consists of revenue expenses to meet its operating demands like salaries, wages, pensions, subsidies, and interest payments, are budgeted to grow at 6.7% from the revised estimates. Capital expenditures, as discussed earlier, is at 11.2 lakh crore for fiscal year 26, an increase of 10.1% from the revised estimates. If you remember, the capital expenditure for FY25 was budgeted at 11.1 lakh crore. However, the government will significantly undershoot the target and achieve close to 10.2 lakh crore. Compared to the budget estimates of 48.2 lakh crore, total expenditure turns out to be 1 lakh crore less at rupees 47.1 lakh crore in the revised estimate. So overall, while the total income for fiscal year 26 is 34.96 lakh crore, the total expenditure is budgeted to be 50.65 lakh crore, creating a fiscal deficit or borrowings of 15.6 lakh crore, equivalent to 4.4% of GDP. Another interesting fact is that the normal GDP growth is pegged at 10.1% for fiscal year 26. Now, to understand how the government will manage its finances for fiscal year 26 in simple words, let's look at this pie chart. Considering the government gets a rupee in revenue, here is a breakup of how much it comes from different sources. Out of the 1 rupee that the government earns, income tax makes up 22 paise, followed by GST and other taxes at 18 paise. Corporation tax makes up 17 paise, and more often than not, the government isn't able to generate the entire amount that it needs to finance its expenditure through taxes and resorts to market borrowing. Borrowings and other liabilities will comprise 24 paise in its overall pie. Now, the government also has to spend money on big investments, infrastructure, and expenses like salaries. On the expenditure front, interest payments on past borrowing forms a major chunk comprising 20 paise. States' share of taxes and duties will account to 22 paise. This is followed by central sector schemes at 16 paise. Centrally sponsored schemes as well as defense expenditure is at 8 paise. The government will spend around 6 paise on various subsidies while 8 paise is spent on other expenditure forms. Now, what about fiscal consolidation? India continues its commitment to fiscal consolidation. Basically, as we understood earlier, fiscal deficit essentially shows the amount that the government borrows from the market. It does so to bridge the gap between its expenses and income. Do know that bringing down the fiscal deficit is crucial because a large deficit means the country isn't able to manage its income and expenses effectively. Not only that, but it also affects India's credit rate. Now, if you look at the image on the screen, back in 2021, the fiscal deficit was 9.2% as a percentage of GDP, which was much higher than expected because of all the extra government spending due to the pandemic. But since then, the deficit has been gradually declined. For 2024, it was reduced to 5.6%, and for 2025, it dropped to 4.8%. Looking ahead, the union government sets an ambitious target of achieving a fiscal deficit of 4.4% for fiscal year 26. But how is the government maintaining its fiscal consolidation path? Over the last few years, the government has received healthy profits and surplus dividends, especially from RBI and several PSUs. In fact, for fiscal year 25, the government received 2.89 lakh crore, and this is further expected to increase to 3.25 lakh crore. Secondly, the government has kind of shrunk its budget. If you see the image, since fiscal year 22, the government has increased its receipts as a percentage of GDP from 9.4% to 9.8%, an increase of 40 basis points. At the same time, it has cut the fiscal deficit by 230 basis points from 6.7 in fiscal year 22 and expectations to 4.4%. This has come on the back of a 190 basis point decline in expenditure, with revenue expenditure declining over the years and capital spending also being steady this year as a percentage of GDP. Lastly, despite tax rationalization, overall tax receipts are expected to remain strong, supported by robust income tax growth. Increased economic activity is likely to boost employment, leading to higher income tax collections and strengthening revenue inflows. Overall, the government has done a fantastic job with its finances and bringing its fiscal deficit down over the years. Now, before we conclude, let's look at the allocation to different ministries. The Ministry of Defense received the highest allocation of 6.81 lakh crore, with an increase of 6.3% from the revised estimates of last year. Second came in Ministry of Road Transport, Highways, followed by Railways at 2.87 and 2.55 lakh crore respectively. Now, what sectors could benefit after the budget? After the announcement of income tax exemption up to 12 lakh rupees, this is expected to encourage spending on goods and services as it leaves individuals with more disposable income. This will directly benefit the FMCG companies like HUL, IDC, Dabur, Marico, Nestle, and consumer durable companies like Voltas, Whirlpool, Blue Star, Havells, Titan, and several others. On the same lines, with more disposable income in the hands of people, auto stocks, which have seen muted demand over the last few quarters, will witness renewed demand, especially in the entry-level segment. Tata, Mahindra, Hero, Bajaj, TVS, Eicher Motors, etc. will be benefiting. Finance Minister also announced 100% FDI from the current 74% in insurance. This move aims to attract stable foreign investment, enhance competition, improve insurance penetration, and align with global practices benefiting both the industry and customers. The government aims to boost fisheries in the Andaman and Nicobar and Lakshadweep for growth and sustainability. The Kisan Credit Card will continue offering short-term loans to 7.7 crore farmers, fishermen, and dairy farmers. Key beneficiaries include Godrej Agrovet, Apex Frozen Foods, and Avanti Feeds. The Finance Minister also announced plans to boost medical tourism under the Heal in India initiative, partnering with the private sector and easing visa norms for better accessibility. This move is expected to enhance healthcare infrastructure, benefiting hospitals like Max Healthcare, Medanta, Apollo, HCG, and Jina Sikho. Moving on, even agriculture stocks will benefit after the Finance Minister announced agriculture as the first engine and laid down measures to boost pulses production, a national mission on high yield seeds, and a dedicated Makhana board. The FM also unveiled plans to develop clean power technology ecosystem focusing on solar PV cells, electrolyzers, and grid-scale batteries to drive India's clean energy transition. Beneficiaries include Worry Energies, Suzlon Energy, Adani Green, and Inox Wind. Lastly, the finance minister announced a 5-year mission for cotton productivity to boost cotton farming, sustainability, and extra long staple varieties with advanced science and tech support. This aligns with the 5F vision for textiles benefiting farmers and ensuring quality cotton for the industry. Key beneficiaries include Ambika Cotton, KPR Mills, Vardhaman Textiles, and Arvind Fashion. Now, to conclude, what can we make of the budget? In 4 words, growth with fiscal prudence. This year's budget was crafted in a really tough environment with both domestic and international challenges at play. Just think about how volatile the Indian markets have been lately and how foreign investors have been pulling large sums of money outside India. Despite all that, the government has aimed to strike a balance between growth and fiscal discipline. Now, the union budget is often perceived as a statement of accounts, but its true importance lies in the direction it sets for the economy. This year, it signals a clear message. We're focused on managing the books responsibly while still driving growth. Here's the proof. The fiscal deficit has been lowered to 4.8% of GDP this year and is targeted to hit 4.4% next year, better than street expectations. On the consumption side, taxpayers get a big win with tax cuts for income up to 12 lakh rupees. And from an infrastructure perspective, there's a 10% increase in capital expenditure at the central level. Now, what does all of this mean for you as a taxpayer and as an investor? Both are net positives. As a taxpayer, the direct benefit is obviously with lower taxes in your pocket. As an investor, the story gets even better. More consumption boost means higher earnings, potential, and stronger funding for future growth. In other words, the budget plants the seeds for sustained economic growth while keeping our financial house in order. Having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.